Hello, this is number 4 in a series of 12 videos called 12 Fatal Mistakes that Property Investors Commonly Make and How to Avoid Them. Mistake number 4 is believing the valuations. There are two parts to this, getting distracted by the misleading discounts offered by developers for new build or by being put off by a surveyor's down valuation. New build and off-plan properties. The optimism shown by some developers in their valuations can be quite touching, really. However, more money has been lost by new investors lured into buying off-plan or new builds by juicy discounts and glossy lifestyle brochures than any other single type of property investment. If you drive a new Mercedes off the forecourt, it's lost up to 25% of its value by the time you get 10 miles down the road. New builds are much the same. It may be tempting to grab a 20% discount offered by a developer for off-plan properties in the development, but if the claimed value is inflated by 30% over actual fair market value, it's not much of a bargain. The optimum time to buy a new build is 3 to 5 years after it was first released, because it commonly takes that long for new build properties to grow any equity. This is dangerous for the inexperienced investor because you cannot sell without loss if your circumstances change or the interest rates rise or the market bombs. There were many investors who suffered horrible negative equity after the last crash and either had to finance negative cash flow from their own income or sell at a huge loss. As Warren Buffett said, you only know who's swimming naked when the tide goes out. So make sure you protect yourself from low tide embarrassment by only buying significantly below market value or buying property to which you know you can add significant value. At the other extreme, many investors are unnecessarily put off perfectly good housing stock by overly pessimistic lender valuations, especially on property needing refurbishment. Surveyors are by nature a conservative lot and can be sued for professional negligence by a lender who's left holding an overvalued property after a repossession. Add to that their professional body, the Royal Institute of Chartered Surveyors, with all the optimism of Eeyore with a hangover, and it's not surprising that surveyors often kill a purchase by valuing it 10 or even 15% below local sold comparables, particularly if they're out of area. Of course, this is only a problem if your mortgage depends on the valuation matching your offer price, and you can often use a low valuation to renegotiate with the vendor. It's hard for a vendor to argue with an independent professional advice. So let the lender be the bad guy. Lenders never lend over above their surveyor's valuation. It is theoretically possible to contest a valuation with a privately commissioned RICS survey, but lenders are unlikely to be swayed unless you can prove that the surveyor was professionally negligent. For instance, he mixed up your address with another of his surveys, but good luck with that one. It is, however, sometimes useful, especially when investing other people's money, to commission an independent RICS valuation, and this will usually cost somewhere around the £450 mark. Always check local, say within quarter of a mile, house prices, they're called sold prices on Rightmove, or Zoopla, and if there's a particular property you're interested in, then Home Track. Actual values usually lie between for sale and sold prices, and much nearer sold prices in this lower point in the property cycle. It's worth asking local agents for a realistic purchase price, or what they call a 90-day sale price. If you'd like transcripts of these videos and for more information on flips or buy-to-let property investment generally, or have a look at some of our recent deals, DM Roland Kane at LinkedIn or email me Roland at partners-in-property.com. Thanks for listening.